What happened with the bond market in the UK should be concerning to everybody, and we are seeing ripple effects here in the US as well. When economists and analysts talk about a 2008-like black swan event, it is usually because there is something unforeseen in the financial system that is over leveraged. And once that hidden leverage becomes uncovered and unravels, that is what leads to black swan type events. Now, before we get into the story in details, in summary, what's happening is that the US Treasury is now exploring the purchasing of bonds. Yes, you heard me right. The US Treasury. Do not mix that with the Fed. Now, if you're a fan of this channel, you know that this comes at odds with what the Fed is trying to do, which is quantitative tightening. The exact opposite of buying bonds. They are trying to release bonds off of their balance sheet. So why is the US Treasury doing this, and why could this lead to a black swan type of event if we have a lack of liquidity in the bond market? And furthermore, what does this mean for your stocks and the stock market as the S&P 500 is sitting at the very pivotal 200-week moving average here? Are we finally going to find some interim support, or is the market going to finally break through this level and keep crashing? And I'll also give you an update on our plays and how I'm planning on approaching the market going forward. Again, another jam-packed video. Let's get right into it. Now, before I get into the main story with the Treasury buying back bonds, the volatility that we are seeing in the market is really presenting us with some great day trading opportunities, especially on 0 days to expiration SPX options. We had one SPX put that we ended up closing for 585%, another one that ended up closing for 70% at the max. We were also selling covered calls on the downtrend, and we have a bunch of cash secured puts open. And because the dividend yields on some blue chip and semi-blue chip companies right now look attractive, I'm also looking to pick up some of these shares and potentially sell calls against my share, not only picking up dividend yields, but also making money on the shares themselves. If you want access to all of our plays, click the link in the description. There are only a few spots left for October. Book a free call with one of our ambassadors, and they'll get you well on your way to applying to the academy. Okay, so why is the US Treasury doing this? Well, the US Treasury is worried about liquidity in the bond market. See, what happens when there is a lack of buyers of bonds, and remember, the bond market is way bigger than the stock market. Yes, this is my shitty drawing representing bonds. The bond market is $24 trillion. The stock market is around 16 trillion. So way bigger than the stock market. And what happens when there aren't buyers for these bonds is the yields start going up to make the bonds more attractive, so that investors can actually start buying bonds again. But when the yields go up, what happens is the bond prices start tanking. Because remember, there's an inverse relationship between the bond yield and the bond price. Now, in a normal market, these fluctuations are okay, but we are nowhere near a normal market here, especially what was uncovered in the UK. Now, why are rising yields bad? Well, rising yields are bad because it makes everything more expensive very rapidly, especially when those yields are rising rapidly. So everything from mortgages to car loans. Yes, this is a drawing of a house. I'm going to stop drawing. Everything from mortgages to car loans, the cost of financing personal debt as well as commercial debt, expanding businesses, etc. When rising yields go up really fast, that tends to break the economy and really cause a hard landing. And the fear there is that that a recession will happen if yields keep rising fast enough. Now, the further danger is what is going on with the UK. If there is some sort of over-leveraged element of the financial system in the US, like we just discovered with the UK pensions, then rising yields could break something, not only cause a recession, but break something fundamental and cause a broad-based recession that can last a very painfully long time, like 2008 did when we uncovered the over leverage that was in the mortgage-backed security space. So what happened in the UK was you had these pension funds, right? So these managed funds that manage people's pensions. They're usually very large funds because a lot of people are on pensions. Now, obviously, they're not just taking people's cash and keeping it. The pension funds themselves are investing to grow the cash that they have collected from people, and workers are entrusting the pensions to invest that money wisely. So classically, these pension funds would buy what are called gilts. These are the equivalent of US Treasuries or US bonds. However, very recently, they started buying into derivatives that are essentially leveraged gilt funds. So if a gilt or a treasury goes up, by 10%, these leveraged gilt funds that these pensions have bought into will go up by 30%. You can think of it like almost a 3x leveraged ETF. Now, what happens when the value of gilts goes down? Well, obviously, it goes down disproportionately as well. Now, because these leveraged gilt funds are bought on something similar to margin, well, if the value of gilts drops sharply, then these can essentially be margin called and these pension funds can go broke. Now, again, in a normal market, these up and down fluctuations are fine. But not only is the UK in a very terrible inflationary situation, much worse than the US, but their new Prime Minister, Liz Truss, decided to implement a debt finance tax cut mainly for the wealthy British citizens, during a time when inflation is wreaking havoc on the UK economy. Now, what makes it debt financed is that they're going to have to sell more bonds in order to finance these tax cuts. So what happens when you issue more bonds into the already flooded bond market where there's a lack of liquidity? Well, you are going to increase the supply of bonds, which is going to tank the value of these bonds, or gilts as they are called in the UK. And that is exactly what happened. There was a panic bond sell-off or gilt sell-off because of the tax plan that she proposed, which is going to be debt financed, which is going to massively increase the supply of gilts, which when you increase the supply and don't meet that at the demand side is going to drop the value of these gilts. So these pension funds that have been holding essentially, let's just call it 3x leveraged gilt funds, now the value of gilts dropped sharply, unprecedentedly, and they were getting margin called. So essentially, the UK was minutes away from total financial collapse. We are talking about trillions of pounds here. We're not talking about paltry amounts. And these funds essentially hold UK citizens most of their life savings. So what had to happen is the Bank of England, which is their version of the Fed, had to come in and start buying bonds to improve the liquidity in that market. And moreover, the UK Prime Minister had to roll back those tax cuts, those idiotic tax cuts that couldn't come at a worse time because of the panic that it caused in the market. However, this uncovered a hidden leveraged risk that wasn't known before, that these pension funds are engaged in really risky behavior and were on the verge of complete collapse, and who knows, could actually collapse, because the Bank of England said that we're only going to be doing this for 3 days. Get your shit in order, start liquidating your assets to raise the funds to pay for these margin calls so you don't go into complete collapse. Now, who knows what's going to happen after those 3 days? The 3 days ended last Friday as of the time of this recording. They did not say that they were going to come in and buy more if need be. They said, you have 3 days, that's it. We're not going to be buying bonds. Because remember, just like the US, the Bank of England is trying to offload bonds off of their balance sheet to do quantitative tightening to fight inflation. They're not trying to be in a bond buying environment. So Janet Yellen saw this, who is the Treasury Secretary, and she said that she's now worried about the loss of adequate liquidity in the US government bond market, especially as Jerome Powell is starting to offload bonds off of the balance sheet. So she said that they're considering buying back bonds in order to improve liquidity in the bond market. Obviously, this goes against QT, which Jerome Powell and the Fed are trying to do. The Treasury and the Fed are completely separate entities. The Treasury is part of the federal government. The Fed is a completely independent central bank. So this is not great news at all if you're tracking the health of the economy and, what in the economy could potentially send us into complete collapse, 2008 style. In 2008, minus a few people, the hidden leveraged risk in mortgage-backed securities, nobody really saw it coming unless you were you were in the weeds or somehow behind the curtain, kind of like Michael Burry was. You really would not have known that there was a problem brewing and there was that hidden leveraged risk in mortgage-backed securities that nobody could really see until it actually blew over. And in this case, what happened in the UK, the pension funds, no one really paid attention to how the pension funds were over leveraging themselves in order to try to make as much money as possible by investing in these basically leveraged gilt derivatives. And now the US is trying to get ahead of itself and say, hey, The bond market, we actually need to improve liquidity, because if we get into a situation where bond yields rise rapidly and bond prices tank, then something in our financial system could end up breaking. This is an ongoing story, and I don't know how it's going to be resolved. And really, nobody knows how the Fed's quantitative tightening is going to end. Whether it's actually going to end in a hard landing, or there is a chance for it to actually go smoothly, because it is unprecedented. And the amounts that they are looking to unravel off of the balance sheet, $95 billion a month, is unprecedented as well. So to me, it's not unfounded here when Michael Burry is sounding the alarm on some of these underlying issues. And when you hear real economists talk about the bond market, it's because they know that the bond market is a much better predictor of recessions than the stock market is. The stock market is really meant as a speculation environment where you are giving companies high valuations based on what you think they're going to do in the future. Bonds are risk off assets. They are the lowest risk investments that we have in the US market. And so when bond investors themselves are not willing to buy bonds, that is a bad sign that a potential collapse is underway. Now, what really worries me is more so what's going on in the UK and not really the US, because that hidden leveraged risk was already uncovered. And I don't think that you just sweep it under the rug. So the Bank of England coming in for 3 days to buy bonds and say, hey, we saved the day. All right, this problem no longer exists. I don't think that's the case. I think that you can't sweep something like this under the rug, and it will continue to be a problem. What that means for the US market is, if we do have a liquidity problem in bonds, and you can see here the 10-year, it closed the highest ever since 2008. We're talking about a 14-year high here in the 10-year Treasury. And it could keep going up because the Fed is looking to raise rates in November and December as well, because inflation is still coming in super hot. The more that bond yields rise, the worse it is for stocks. Also, we've never seen a complete bear market bottom while the Fed was still hiking. So I do not think that this is the bottom here. The Fed is going to have to come out and say, okay, we've done our job. We're not hiking anymore. And I don't think the Fed can do that. We are so far away from that. If you look at the federal funds effective rate minus CPI, we're still at -4. So the federal funds effective rate has to get above CPI for inflation to really come down. So in my view, this is not the bottom. Now, we could be on the cusp of a violent short-term rally. You already saw on Thursday after CPI was released, the market do a miraculous 6% turnaround. We're talking about the S&P 500 and the NASDAQ. And we are already getting a lot of oversold signs in the short term. However, if I take a look at the VIX already showcases a golden cross here, and a golden cross, which is a cross between the 50 moving average and the 200 moving average. This right here is not a good sign. The last time that this happened was in the end of 2021. The VIX essentially went from 20 to 40. And then back in March 2020, the VIX essentially went from 20 to 85. And we are seeing that golden cross again. So we could be on the verge of a lot of volatility. Remember that we also have earnings coming up at the end of October. And we're talking about the mega cap earnings, right? Apple, Microsoft, Amazon, etc., Tesla. So if earnings come in with bad guidance, if earnings show that they are heavily affected by what's going on in the economy, then we could see the next drop in the stock market. However, if earnings come in and surprise, we could see a short-term bounce here due to the fact that we have a lot of oversold technical indicators. But the bigger picture, until the Fed funds rate is, no longer going up in perpetuity, or what seems like in perpetuity, we're not going to find a bottom to this bear market. Now, there are quite a few stocks here that do look like good pickups only because of the dividend yields that they're dishing out. So, in my view, you definitely want to look at a company's cash. You want to look at a company's debt. Do they hold a lot of debt or not? And then you also want to look at their dividend yield, right? And whether they are a blue chip or semi-blue chip company. Because in this case, if a company is in a good position financially at the moment, they don't hold a lot of debt. They have very high margins. And they also pay out a dividend yield that is comparable to what you see with bond yields, or even higher to what you see with bond yields, then in my view, those companies can, start to be dollar cost averaged into because of the yield that they pay. You are guaranteed to get those dividend yields if you invest in those companies. And then you could do things like sell covered calls against your share to pick up even more money and let your shares work for you. But right now, the 1 year yield's paying almost 4.5. The 2 year yield's paying almost 4.5 as well. So if you can find companies whose balance sheets you like, that are at a major discount, that also have a good amount of cash generation, and pay a yield that is higher than some of the treasuries that you can get at the moment, then I think that those are okay, in my view, to pick up if you are banking on the long term. You don't mind picking up the yield. You don't mind picking up the cheap stocks, buying equity in those companies. And also, if you know what you're doing, you can then sell calls against your shares and make even more money from your shares. But that is it for this video. Leave a comment down below. Let me know what you think of the US bond market. Let me know what you think if we are on the verge of collapse. Have you started buying, etc.? Again, sign up if you want access to all of our analysis, our alerts, our day trades, our swing trades, options, futures. We do it all. There are a few spots open for October, so sign up. Hit that thumbs up if you get anything out of this video. Stay safe out there, traders. Peace.